This TCJA presentation is going to be covering the changes that are introduced through HR 1, also known as the Tax Cuts and Jobs Act, or the TCJA, mostly identifying legislative changes that are affecting the returns for tax year 2018 and beyond, principally focusing on individuals for the purposes of this presentation. The reality is there are so many changes, because this is the most substantial change to the tax code since 1986, that you could probably easily pull this out, and there are other CE packages that do pull it out for 8 to 20 hours or more worth of content. We're not going to be doing that today. We've got a couple of hours here, and there will be a few other updates, webinars as well, that are hosted in the future, and in some cases pre-recorded for you guys, so that way you can get your credits. In particular, if you are like a CTEC preparer, for instance, and you need those update hours before the due date in October. We're going to also talk about some of the continued implications in the statutes that are in effect and have been in effect for the last few years. There are some things that were expired actually when 2017 came around and were retroactively introduced through bills like the Bipartisan Budget Act 2018 and so on. And we're going to talk about some of the changes to forms most likely to affect the average taxpayer, some of the IRS policies and procedures, and as well a little bit of pontificating on some hypotheticals. There are a lot of problems in this bill and a lot of interpretations that need to be clarified. I can tell you right now, for instance, that if you've gone online to look up numbers relevant to, for instance, inflationary figures, it's very likely that over half of the websites that you come across are going to have wrong information. The IRS typically releases inflationary figures in the summer of the tax year in question, so you get them a year, or half a year, I'm sorry, before you actually file the return. And a lot of websites are going to be based on that information. Well, the IRS had to release supplementary documentation. It's where most of this comes from. Revenue Procedure 2018-18 and 2018-10 to sort of clarify a lot of this stuff and make sure that some of these figures, in many cases, dropped back down from their original higher numbers. Just a little bit of discussion about the state of the legislature. I don't usually like to spend a lot of time talking about politics because it is such a tentative subject and always changing, and everybody's got different opinions on it. But what I do want to point out is that right now is a little bit of a mess, if you will. There were a lot of procedural issues with the passage of the bill. A lot of stuff needs clarification, as I mentioned before. IRS is going to be releasing revenue procedures and revenue bulletins. Treasury Department's going to weigh in on some things. Various other government departments and agencies that have figures that go and are used in the tax code, the Department of Labor, the Department of Health and Human Services, all of these things are all going to be interacting, and it's a lot more difficult considering the amount of changes. For comparison, I've got a book on the side of my desk that is just the text of HR 1, and we're talking maybe size 6 font, and this thing is something right around 600 or 700 pages thick, about 3 inches thick, right over here to my left as I give this presentation. So there's a lot of stuff that's on there. This is a comprehensive tax reform on almost every single level. Individuals, partnerships, corporations, you name it, something's touched it. And you can expect a lot of stuff that I say now to possibly be up for review. I am going to be going through out the year, hopefully providing errata and corrections when necessary. With that being said, I am going to talk about what things are different, and a lot of these are going to be inflationary. So there are some things that come up and down to inflationary changes, mileage rates, etc. Some of them stayed the same, others have dropped. Wherever it's relevant, I've tried to do a color coding system to make it a little bit easier to show what's gone up with a green and what's gone down with a red. That doesn't necessarily mean it's good or bad. By the way, it just means that the numbers are different and they've been identified as such whenever possible. It's not exactly the same system as it was in 2018 as it was in 2017. So a lot of the stuff that you might be familiar with, for instance, personal exemptions are completely gone and replaced with something else. So in many cases, those numbers and whether they go up or down, it's going to be a little bit more difficult than it is in prior years. I can also tell any of you that if any of you are interested in becoming enrolled agents, you do still have the ability to take the special enrollment examinations under the old tax law right now before it switches over sometime in the beginning of next year. So there is a time running out on that in order for you to have to learn entirely new things. If you've been doing this for a while and you've been looking for an enrolled agent credential in your future, now is probably the time, unless you want to go into the test trying to memorize all this stuff as well. So standard deduction amounts, you can ignore the fact that says TY 2017, for instance. What we're looking at is numbers, okay? And these numbers are going to show what the values are. In many cases, you can just expect the married filing joint and the single numbers to be twice as high as each other, and the head of household to be somewhere in the middle. The standard deduction is increased massively. Married filing joint, qualifying widowers, we're dealing with a $24,000 standard deduction. Okay, you're dealing with an $18,000 standard deduction for a head of household, and a single or married filing separate standard deduction of $12,000. In addition to that, exemptions are suspended until 2025. There will be a lot of talk about repeal. There will be a lot of talk about suspended. The important thing to remember is that when someone mentions suspension in the context of the TCJA, they are typically going to be talking about the period that encompasses tax year 2018 until the end of 2025. So when we talk about that, when I say suspended, most of the time that's what I mean. I try to use the word repeal to indicate that it is no longer there or that it has expired and has not been renewed. There are a handful of those, and I do have a little page dedicated to that towards the end where we'll kind of do a quick recap of what's different. But a lot of this stuff, in order to pass bird rules for budget reconciliation and avoid having, or basically making it a simple majority vote when it was getting passed, had to have all kinds of sunset clauses in there, so that way the total revenue impact projected from the various other government agencies that were evaluating these types of things to make it fit within the bird rule limitation. So for a lot of these individual changes, they only exist for right now until the end of 2025, and then the beginning, January 1st, 2026, they come back. And in order for them to come back, that keeps the government from hemorrhaging money in the context of the economic period that they're looking at. And one of those things is that there are no more personal exemptions. This is one of those provisions that is suspended. So you will not get a flat figure. Okay, for instance, for any person on the return like you would before, that would calculate against your taxable income. So the size of your family, at least in regards to this aspect of the tax code, doesn't matter anymore. If you have ever looked at a return and you were debating on whether you were itemizing or not, you might have had that moment where you realized there was no taxable income because your taxpayer, despite being able to itemize in any other sense of the word, has 6 kids on the return. It doesn't matter. Everybody's going to have standard deduction amounts based upon their filing status, 24,000, 18,000, 12,000, and the exemptions are just completely gone. Where they are relevant, however, is that those figures, the $4,000 or the $4,050 that it would have risen to this year had it been kept in the code, those figures are still useful for other aspects of the tax code. For instance, for qualifying the gross income test for your qualifying relatives was chained originally to those exemption figures. So anywhere where those numbers are relevant, the numbers are there, and there are supposed to be chained to inflation. So for instance, that 40/50 figure, you might keep that in the back of your mind as the gross income test threshold for the qualifying relative. And a lot of this stuff will be placed into and explained in more detail in the IRS publications as they come out more towards the end of the year. The blindness and disability deductions under Internal Revenue Code Section 63F are still in play. So if you have an age or blindness exemption, then those will add on top of your standard deductions. So $1,250 for joint filers and $1,550 for age and blindness for everybody else. And those are tracked independently of one another. So they will add up. You got 2 blind people, you'll double it. If you have, 2 blind and elderly individuals, and you'll have 4 of them added on top of these figures up there. The kiddie tax, we'll talk a little bit more about that. Originally, it was based upon a flat figure then multiplied by 10. This is under IRC 1G4A2I or whatever that is. That's actually been capped up to the top at 12,000. Okay, we'll go into a little bit more detail about that because the numbers are not as important as the fact that the taxing structure for kiddie tax is completely different. So we'll touch base on that a little bit as well. Alimony payments. This one is a big deal. It's not going to apply for this coming tax year. Some of the things, alimony, the individual shared responsibility payment, those were not suspended or repealed for the 2018 tax year, but from 2019 onwards. Alimony is from divorces that are going to be executed for tax year 2019 and forward. They will no longer be excludable from the payer, and they will no longer be considered income to the recipient. I do and have seen a lot of discussion over that, especially for people who have alimony agreements that they attempt to modify. But to my knowledge, that will be grandfathered in under old law for people who are currently under an alimony situation right now. And I'd imagine a court case will probably clarify it in the future. Standard deduction amounts for dependents that file their own returns are under the same rules as they usually are, in that the value of the deduction cannot exceed the greater of either $1,050 or the lower range of this kiddie tax range, or the earned income that they made plus $350 up to the limit given for an individual filing a single return. So if you have a dependent with, unearned income of some kind, they get basically either this $1,050 figure as a standard deduction, or they get whatever money they actually make earning money. If 16 or 17-year-old makes enough, they want to file a return, get some of that withholding back at the end of the year, whatever they earn plus $350. That's not really significantly different. The threshold for itemization, and this is where a lot of the really big changes happen in regards to this code, are in regards to itemization, because itemization costs the government money by lowering your taxable income. So it was one of the areas that they hit fairly hard. The threshold for itemization is drastically increased because of that standard deduction. You only itemize when the category of expenses that you can consider going into a Schedule A are larger after applying your various limitations than your standard deduction. And since standard deductions are massively increased, itemization itself will also drop. So there's going to be less itemizing overall. And there are a couple of these that I will talk about that will make some of you in the audience probably fairly upset because they are big for your clients. Home mortgage interest deductions are going to be reduced down to $750,000 in acquisition debt from the original $1 million. Now, this is not really a big deal for most people. Not very many people have a primary home with a mortgage of greater than $1 million, except in some very large and primarily coastal cities. The way that it worked typically is you would essentially prorate the amount of your mortgage that could be considered deductible from its percentage. So if you had $1.5 million, then you would basically be taking 2/3 because you'd be only able to use up to $1 million, etc. Most of the time, if you have $1 million mortgage, you're probably going to, at least under the old law, have a high enough income to where you most likely we're not going to be itemizing at the full value anyway because of P's limitations. But they've dropped that down for mortgages executed from 12/15/2017 onwards to $750,000 in acquisition debt for home mortgage interest. Home equity debt deductions, or a home equity line of credit, HELOC, those have been repealed. So it used to be that you would be able to take interest on up to $100,000 of home equity debt. Unfortunately, in the future, that is now gone. Now, I do want to point out, and the IRS actually had to release clarification on this, that don't look at the name of the loan. The label of the loan is not as important as what the loan does. A home mortgage interest, or a home mortgage in the context of the tax code, does not need to be called the home mortgage. A home equity debt that is actually used to buy or build a home is going to be considered deductible. I could go into more detail for anyone that has questions on that one at some point in the future. But as of right now, I just want to point out that don't just look at the name of the loan. Look at what the loan is made to do. Some people get home equity loans to do things unrelated to building or improving their home or buying a home, etc. So you got to see what it actually does. You got to trace it, the tracing rules. I do have some charts I could probably show some of you guys sometime, give an example of what I'm talking about. This one's big. The state and local tax deduction, the SALT deduction, is capped at $10,000. So that means normally, if you were paying state income taxes, if you had local taxes withheld from your return, you had your individuals that live in a high tax area, primarily blue states on the coasts and some large cities. You used to be able to take all of those, or your high income clients that might be paying a significant, maybe even multiple tens of thousands of dollars in state tax. The aggregate total of all of those taxes stacked together is going to be capped at $10,000, which means that the rest of it is going to be gone. And as well, Congress has preempted the possibility of individuals prepaying their state and local taxes to prevent you from, for instance, paying a whole bunch right now and then attempting to claim that as a deduction, on returns, and attempt to exceed and break these particular limitations. All right, medical expense deduction threshold. This is actually good for individuals who have medical expenses. The threshold remains 7.5%. It was set to go up to 10% for everybody. There was a little bit of a sunset clause for individuals over 65 to take it. But as for right now, 2018, 7.5% of your AGI is the limitation where your medical expenses have to exceed it in order to be considered itemizable. Once 2019 hits, that will return to 10% for all tax filers, but you do get one extra year of having that 2.5% decrease, which lets you claim more medical expenses in the case that you do happen to itemize. And then this next one is probably the biggest one on here for at least a lot of the people that I know traditionally attend these webinars, and that is miscellaneous itemized deductions that are subject to the 2% of AGI floor are disallowed until after 2025. So from now until the end of 2025, you will not, for instance, be able to itemize unreimbursed employee-related business expenses or investment expenses. They will not be capable of being used on a return, on an itemizable return. So your road workers and truck drivers on a W-2, your individuals who work in trades and have to spend money on union dues, equipment shoes, unless they're running their own business and they have their own economic schedule separate from being an employee for somebody else, they will not be able to deduct any of it whatsoever. As well, we do have something else that is new that might possibly be useful for individuals, especially those of you that have a high amount of sole proprietors or partners in a partnership or S-Corp shareholders. And that is the introduction of IRC Section 199A that introduces a new qualified business income or QBI deduction that is available for certain qualified taxpayers who own and operate their own businesses. So partners in an S-Corp, shareholders in an partners in a partnership, shareholders in an S-Corp, sole proprietors engaged in a trade or business, C-Corp shareholders and employees do not qualify for this, and they need to be engaged in conduct of United States trade or business. Now, we will have a future webinar over this topic specifically, but I'm just giving you the crib notes on this one right now. And what this is you get essentially a deduction valued at up to 20% of your QBI, which is going to be the net amount for the items of income, gain, loss, and deduction from any eligible trade or business, except for your capital gains and losses, your dividends from real estate investment trusts, co-ops, and publicly traded partnerships. If your QBI comes to a net loss, then that loss just carries over to the next taxable business year as a loss from a separate qualified trade or business. And this has got zones, okay, based on taxable income. You have the lowest level, zone 1, and that's when your taxable income does not exceed $157,500 or $315,000 for joint filers. Like I said, generally speaking, joint filers are going to be double the number for everyone else. Zone 2 is going to be for those individuals between $157,500 and $207,500, or $315,000 to $415,000, and then Zone 3 for taxable income more than $207,500 or more than $415,000 for married filing joint. For your Zone 1 taxpayers, the full QBI deduction is going to be 20% off of that QBI, regardless of your business type. So most of your smaller businesses or sole proprietors who don't break that $157,000 or $315,000 threshold will probably be able to take a full 20% off of the taxable income of their return from having a self-employed business of some kind. Your Zone 2 taxpayers, you might possibly have a reduction against that QBI if you have insufficient wages paid and or they are called a specified service business, okay? And then your Zone 3 taxpayers cannot use it if they are a specified service business type in order to qualify for the deduction. That includes your health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, or brokerage services, where the business's principal asset is the reputation or the skill of the employees or owners. And the services consist, and services also consist of investing, investment management, trading, or dealing in securities, partnership interests, or commodities. And Josiah did shoot me a message over about this one as well, that this particular one is going to be really good for any of you guys out there who are Uber or Lyft drivers, okay? Because most of them are probably not going to exceed being in zone one. And so there you go, 20% off the money that the net money that they report, against their taxable income. I mean, that sounds like a win for anybody that is not supposed to reduce that, based on their income or their business type. To give an example, we've got a couple examples here. We have a specified service business, okay? So it's one of those ones described earlier. We got a married couple. They have $200,000 in net income from specified service business QBI and an overall taxable income of $375,000. You're going to take that zone minimum amount, $315,000. It leaves a little extra, over $60,000. They're going to divide the amount above by $100,000 to determine the reduction percentage, 60%. Take that reduction percentage and apply it to the QBI to determine how much you must reduce it by. So they have $200,000 of QBI, and they got to essentially multiply it by 60%, $80,000, okay, and then multiply that reduced QBI by 20% to determine the deduction. So you're going to start off with your taxable income. You're going to take your threshold away. You're going to divide it by 100,000 to get a percentage. You're going to take that percentage. You're going to multiply it by the QBI, and then you're going to multiply that reduced QBI by 20% to determine. So from this business, they're going to get to take $16,000 off of their taxable income. And I would like to point out that while it's important to know these numbers right there, it is a very real probability that there will be a yes or no type of question worksheet in most commercially available software where you will be able to have this figured out for you, and the worksheet will probably suffice to be able to be printed off and kept in your records in order to show the calculations, and most likely would probably be one of the principal things that is going to be worked on in the off season right now by all of our tax software companies in the country. I got another discussion as well about the wage basis limit, and that can offset the QBI by either the greater of 50% of your W-2 wages that is paid by the business to employees, or 25% of the W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition of any and all depreciable property that's used in the business on hand at the end of the year. So only the taxpayers in the higher zones are going to be having to worry about this, and I'd imagine it will probably mesh nicely with the software that we use and those asset worksheets for those depreciable assets to try and come up with a figure for you. So we got the same situation as before. Okay, same couple. So $200,000 in their QBI, their starting QBI, taxable income $375,000. They have W-2 wages of $40,000, and they have $1 million worth of depreciable property. We get the same reduction percentage, so 60%. We've got to determine that wage basis limit, so the greater of one of these two things. 50% of their wages is $20,000, or a quarter of their wages plus 2.5% of their property, $35,000. That's where we're going to stick it. So we're going to pick the greater of those two. We're going to subtract the wage basis limit from 20% of that QBI. So $40,000 is that 20% of that original QBI figure, minus the $35,000. That leaves us with $5,000 over. We're going to multiply it by the reduction limit to include or to determine the QBI reduction. So that leaves us with $3,000. And then we're finally going to subtract that from the 20% QBI to determine. So they start off with $40,000 of QBI that they're able to take off $3,000. They get $37,000 instead. Okay. Now, so just to recap, we will have a section, a webinar in the future to cover that. I'll get it on the calendar and shoot messages out to all of you guys in the list over there where it's necessary. But long story short, most of you won't ever have to worry about doing these higher level calculations unless you do have people that have a significant amount of assets and or QBI that happens to exceed those thresholds. But for your regular hairstylists, Uber drivers, self-employed truck drivers that have a lot of expenses, I know that typically a net could be between $40,000 and $80,000. I mean, you're looking at basically being able to take 20% off the taxable income. So this is one of the few areas of the tax code that seems to be kind of universally beneficial to everybody. Okay, since we do have different figures for the standard deduction and we don't have personal exemptions anymore, we also have different filing requirements. Okay, so the filing requirement is the amount of taxable income, or adjusted gross income, if you will, that would be needed to be had by your taxpayer before they're required to file a return. Now, I would like to point out there's always wiggle room. So there's asterisks and explanations down there, okay? Generally speaking, though, if you don't have any self-employment income, let's just, for the sake of argument, say individuals with W-2s, okay? The filing requirement for a person younger than 65, single, 12,000, 13,250 for someone 65 or older. Married filing separate uses the single rates, except for they don't get the age exception there. Head of household 18,000, 19,550. For someone 65 or older. Qualifying widower 24, and then 25,250. Your married filing joint 24,000, 25,250 for 65 or older, both over 65. 26,500 and so on. And there are exceptions. So your filing requirements are, going to be based upon whether or not your income hits those thresholds or not. But depending on the type of income, that can change. If you have certain special types of taxes, certain types of distributions, self-employment income of over $400, or church employee income of $108.28, you might be required to file a return even though you're under the income threshold. As well, if you qualify for instance, earned income credit, you technically have to file a return regardless of whether or not you are at those thresholds or not. So something to keep in mind. Typically, your publication 17, when they make the new one, is going to have that chart in it and all the information over the exceptions to it. Same thing for publication 501 as well. All right, FICA and Medicare taxes, the wage base, the contribution benefit base that's determined by the Department of Social Security for the portion of FICA taxes is increased for 2018 up to $128,400, and that's under 42 United States Code, Section 430. It's not really part of the tax code because the tax code is going to be under 26 United States Code. But they do use the numbers from the Social Security Administration in order to determine, for instance, how much you're going to have withheld and pay into the Social Security system for qualifying income. The additional Medicare surtax that was introduced with the PPACA, it's under IRC 3101B2 and 1401B2, that have an additional calculation of 0.9%, was surprisingly one of the things that was actually kept when HR 1 was passed, and those figures are not really subject to any sort of inflationary changes, and they will kick in for taxpayers with earned income in excess of $250,000 for married filing joint or qualifying widowers, single or head of household at $200,000, and married filing separate at $125,000. And I would like to point out this is one of those few sections in the code where the married filing joint is not automatically double the single rate. So there is somewhat of an inherent marriage penalty for individuals that usually make somewhere between, $250,000 to $450,000 of earned income. A lot of times when you get income levels that high, there's a lot of it that's not earned income, investments of some kind, different types of passive income, shares, or interests in different types of business activities. But since the married is not double that one, that does mean that they do pay more tax on that income proportionally than if they were to file separate. One of the reasons why it's always at least recommended to possibly consider filing separate if you do have married individuals, do a little bit of a comparison and see what actually works best for them. Tax rate schedules are going to be one of the other big changes. They keep the same amount of brackets, but they drop 6 out of the 7. And those are the tax brackets that are identified in Internal Revenue Code Section 1. That's right at the front. Then the highest rate for these particular brackets are only going to be triggered for AGIs above the following. $600,000 for joint and surviving spouses, head of household $500,000, single $500,000, married filing separate is $300,000. And the rates themselves have been dropped down to 10. Actually, that one hasn't changed. That one's the same. 10%, 12%, 24 or 22, 24, 32, 35, and 37 drop down from 39.6%. And we got a little breakdown of the brackets over here. For instance, your married filing joint and qualifying widower taxpayers, you can take a look at the tax rate schedules right here. I am not going to read each one of these lines and these ranges, but you can essentially see that basically each chunk of income gets taxed separately. If you're new to taxes, for instance, or you've never really looked at what a progressive tax system is, each chunk of income gets taxed at its own separate rate. So you never actually pay more tax or lose money by earning more money. That's a very common misconception that I run into multiple times a year, where a taxpayer will believe that if they get more money from their boss, that they're going to lose money on their paycheck. They might have more taken out, but it will still be a net benefit to them because the percentages only count for a narrow band of income. So, 10% of that first 19,050, and then 12% of the next chunk of income after that, and so on. I'll keep this up so you guys can take a look at it real quick. Some of these figures had to be adjusted, like I said, inflationary figures, because of a difference in how inflation was calculated, had to be changed from original numbers as they were proposed and introduced in 2017 RevProx. And we're going to go ahead and go to single taxpayers. Just leave it on the screen there for a second. Take a look, see if there's any questions. All right. Yeah, okay. And go ahead and move down one more. Hop down here, head of household taxpayers. Like normal, it's about partway between single and married filing joint. It's not necessarily so much better. I've seen a lot of analysis of the new tax code that seems to say that a lot of single parent households are going to have a more disproportionate impact in the negative against themselves, even after considering for child credits. And part of that is the way that these brackets, for instance, are calculated, among other things. Married filing separate taxpayers still, however, are essentially at the single rates, but they just have a much lower overall threshold for that 37% tax. And as well, they still don't get access to most or really any credits that are going to be available on returns. And there you go. And then finally, estates and trusts. Those brackets are 10, 24, 35, and 37. And even though I'm really mostly talking about individuals, I do want to bring this up right here with these estates and trusts, because the kiddie tax, we'll get to that in a little bit, but the kiddie tax is going to be using these figures. So that's going to be a pretty important change. So you might be using the estate and trust rates a lot more than you were before, especially if you have individuals who live in Alaska, for instance, and their children receive those Alaskan permanent fund dividends. All right, long-term capital gains rates and qualified dividends have been decoupled from tax brackets. Traditionally, in the lower brackets, you'd be 0%, and then in the middle ranges, you would have 15%, and then 20% for the highest tax bracket. They've been decoupled from that, and they are indexed on their own. Those are from Section 1H. The Internal Revenue Code. The top tax rate for collectibles and the recapture do happen to stay at 28 and 25% respectively, and they are all still subject to the 3.8 net investment income tax, or NIIT, that was introduced with the PPACA or Obamacare back 2012. And so the brackets, they've been decoupled from the brackets. The numbers are somewhat comparable. It will result in slightly more capital gains tax rate instead of, because the overall numbers are just a little bit lower than where they put the break points for the bracket. So for your joint filers, 0%. If your your taxable income is $77,200, and then from there up to $479,000 is 15%, and at $490,001 and over, it's 20%. Single, married filing separate, LTCG is going to be 0 on up to $38,600. From 38,601 to 425,815, and then 20% on 425,801 or more. And the head of household LTCG rate is 51,700, and then up to 452,400 for the 15, and then over that for the 20. And then the estate trust one, however, is going to be way lower, up to 2,600, 0. 2,600 to 12,015, and then 20% on anything from 12,701 or greater. All right, the excess taxable income, above which the 28% tax rate applies, has also increased under IRC Section 55B1. And basically for everybody, it's $191,100. except for your married filing separate filers, they're going to be stuck at $95,550. The exemption minimum phase-out amounts are also significantly different. So your joint filers and surviving spouses are at $1 million, and everybody else is going to be at $500,000. So single head of household, married filing separate, estates and trusts. Now that does mean that that's a phase out minimum. So realistically speaking, the phase out amount stops for a joint filer somewhere. It's like, I believe 100 or 1,437,200. There's actually a calculation that factors into it, but the exemption minimum phase out amount starts at $1 million for a joint filer or surviving spouse and $500,000 for everybody else. And then the kiddie tax AMT exemption itself cannot exceed the sum of their earned income plus $7,600 under IRC 1G, Section 55, and Section 59J. I like to put these little IRC notes on there whenever possible, just so that way if you really felt absolutely necessary that you could jump into, jump into 26 USC and just, start finding this stuff there. If you're not a lawyer, don't have a legal background, it can be kind of hard to interpret. I can tell you right now, I don't come from a legal background. It was a little bit difficult for me at first to get used to it, but you kind of get a flow to it once you start reading. So I like to put these up there for you guys as reference. Other changes. Okay, other changes. So limits for retirement accounts. Some of them are the same. Some of them go up a little bit. Not really too much different about your retirement accounts. Your 401ks, your 403bs, and your Section 457 plans still have an annual contribution limit of $18,500 with a $6,000 catch-up for those individuals who are in their 50s. Your simple IRAs are going to stay the same at $12,500 with a $3,000 catch-up. Your qualified retirement plans / KIO and your SEP IRAs are slightly higher. It's still up to 25% of net self-employment or compensation, up to a maximum inflation increased amount of $55,000 with no catch-up provision. Your individual 401ks allow you to have your salary deferrals of up to an uninflated $18,000 plus a profit sharing contribution of 20 to 25% up to a maximum of an inflation increase $50,000 with a $6,000 catch-up. And then your traditional or Roth IRA is still stuck at $5,500 with a $1,000 catch-up. So that's a little snapshot kind of showing you the overall changes, at least to the numbers. There are some other changes that are coming in there. Traditional IRAs, usually it's considered tax deductible unless you're an active participant in a qualified workplace retirement plan like a 401k or 403b. In that case, there are some restrictions. The partial deductibility range, where your deduction is limited, has risen. So from 63 up to but not over 73,000 for a single or a head of household filer. That's the new range for that. Joint filer, 101,000 up to but not over 121,000. Married filing separate never gets a full deduction. So their partial deductibility is basically less than 10,000. And then the range for your non-active participant spouse, $189,000 to $199,000. Generally speaking, these are not really going to be too important unless you're also engaged in the act of financial planning or like helping advise on retirement plans for your clients. So those of you in the audience who were waiting for these figures, you know what I'm talking about there. Otherwise, the IRS has and at least had training materials for people for enrolled retirement plan agents or IRPAs. I'm pretty sure that they're actually discontinuing that plan due to budget restrictions. But retirement plans on their own are significantly complex enough that they have their own professional credential. Taxpayers and filers who are not covered by a workplace provided plan can typically deduct up to the full amount of their contribution limit regardless of their modified AGI. And for married filing separate filers, this does, however, mean that both spouses must not be covered. So as long as you're married, you have the choice to file joint or separate. But if you are filing separate, you can't file separate in order to take a bigger retirement plan deduction. So that does mean in order to claim that full amount up to the MAGI, that regardless of MAGI, that you have to both not be covered. So there's no selective split filing in order to maximize retirement deductibility. Roth IRAs have had some adjustments to their phase-out ranges. Contributions are reduced between 189, but and below 199,000 for a joint filer or surviving spouse. Married filing separate but lived with their spouse, up to but not at or over $10,000. Same situation. Never the full deduction, always reduced in some capacity. And then single head of household, married filing separate but did not live with spouse at all. The phase out ranges from 120,000 up to but not at or over 135,000. Now this doesn't, when I talk about Roth IRA phase out ranges, this is not about a deductibility because Roths are not federally deductible. This is about phase out ranges for whether or not you contribute to the plan. So usually you're going to be sub $200,000 where this is actually still relevant. Your defined contribution plans, like I said before, that goes up to 55,000. The limit on exclusion of elective deferral stays at 18,500, and simple IRAs stays at 12,500. So this is just mostly a longer text explanation of this slide right here, which if you have a copy of the handout, you should see that one visible. There are some other things to keep in mind, some tactics that could be used by crafty taxpayers and financial planners that they've essentially nerfed, if you're willing to excuse some modern gamer parlance there. And that is that Roth IRA recharacterizations. There was a special rule that basically lets you have up to the due date of the return, including extensions, to essentially retroactively change the nature of conversions between Roth IRAs and IRAs in order to take advantage of favorable tax law or tax situations. They have repealed that special rule that allows you to do that. So essentially the characterization of that particular conversion is as it was the time that it happened, as opposed to you getting to pick and choose whichever one is better after the fact. It also does provide an exception, an addition, if you will, to the 10% early withdrawal tax for up to $100,000 of qualified 2016 disaster contributions made between January 1st of 2016 and January 1st of 2018. So anybody who was impacted by those hurricanes, Irene, Irma, and so on, took money out, had a 10% penalty. If your clients have been hit with that 10% penalty, this was retroactive back to January 1st, 2016. So they should be able to go through and 5329 that and get that 10% penalty off, so long as those disaster distributions were qualified and under $100,000, or at least for the penalty associated with up to $100,000 of it. So there's some good news on that one right there. Okay, changes coming on for dependents. These are going to be big. Child tax credit in particular is going to have a lot of differences that are going to be really interesting for a lot of our partners and other individuals who happen to work in lower income or high family size markets. So we do have suspension of the personal exemptions, and that on its own is unfortunate for those individuals who have large families and rely on those figures in order to help lessen their tax bill. That is not honestly offset by the increase in the standard deduction for large families. However, changes to the child tax credit might possibly provide some of the loss of function for them suspending personal exemptions. And one of the things that happens is that the child tax credit that's authorized under IRC Section 24 has been increased from $1,000 to twice that amount at $2,000. So now your child tax credit, so any of your qualifying children who are under the age of 17 at the end of the tax year, can get a possible maximum of $2,000 of CTC. On that return. The additional child tax credit, the refundable portion that comes to you in the form of a credit once your child tax credit is either has excess amounts that can't be applied to a non-existent taxable income, increases to a maximum $1,400. So the way it worked under the old law, $1,000 child tax credit, and it, like other non-refundable credits, would count against your tax liability, and then the excess would be possibly attributed over to you in the form of additional child tax credit as the amount of the excess, 15% of it over $3,000. Well, now it's a little bit different. You get $2,000 as a base, and then whatever's left over, you get $1,400 of that. So prorate it down a little bit under the same system, and that is indexed to inflation. So the $2,000 maximum will stay the same, but the $1,400 portion that's considered refundable will be considered inflationary and will continue to increase up until the point where it hits $2,000 and matches the size of the maximum credit itself. So you can expect the refundable portion to increase in the future. The phase out of the child tax credit amount because of these changes has been increased to $200,000 for unmarried filers and $400,000 for joint filers. And unlike the ACTC amounts, that amount is non-indexed. So essentially, $200,000 for your unmarried individuals, $400,000 for joint filers. Once you hit those income limits, then you lose the CTC. If you're under them, you should be fine. There is a little bit of a decrease in the refundable portion calculation. Like I said, you have your additional child tax credit. They take your earned income, they subtract $3,000, they multiply it by 15%, and that's the amount that you can claim for additional child tax credit at a maximum. Well, they dropped that $3,000 a little bit, so it's now $2,500. So whatever your ACTC is, you have just a little bit more room for that percentage to kick in, which will hopefully help a lot of families out. And then in addition, this is the new one that I've had a lot of questions about, the family tax credit. There is now a $500 non-refundable credit that is added for dependent non-children, qualifying children who do not qualify for the child tax credit, and individuals who do not have social security numbers. It is a requirement for child tax credit to have a social security number now. That is a big change that a lot of people, maybe they were anticipating, I'm not 100% certain, but that I've had a lot of questions about. So in order to get child tax credit, you do need to have a social security number on that dependent. So no more ITIN holder dependents for CTC. It's just none whatsoever. However, on the flip side, if you have an elderly dependent who wouldn't qualify for CTC, or someone who aged out of it, or you have a dependent who has an ITIN number, you could instead possibly qualify for a $500 family tax credit per individual, but these are non-refundable, which means that they won't increase the refund unless you have liability that's not already eaten up by a bunch of other credits. So large family, low income, not going to really see too much of a benefit from this, but this will probably be more beneficial for those that do have dependents in this category who are in the middle to upper middle class ranges, and more, obviously, where the tax liability is likely to still exist even after accounting for your standard deduction and other things. Okay, earned income credit itself, not really that much different. So there's really no major changes to how that credit works. It's still the same type of dependents. You know, you have to have qualifying children of specific relationships and certain limits on the types of income that you can have. I will show you the actual amounts for the maximum credit and everything, because the ranges for the maximum credit values and so on, those have all increased because of inflation. The investment limit for the aggregate investment income rises to $3,500. So as long as your aggregate investment income is less than $3,500, you will still be able to get earned income credit. And that investment income has not changed in its definition, so it still includes interest, dividends, pensions, annuities, and other forms of similar passive income on a return. Now, the actual numbers themselves for the EIC under IRC Section 32B, I'm not going to read every single one of these off. You can see the AGI ranges. As running down, you know, you get your AGI for max credit starts at 10,180, 14,290 for 2 or 3 children, and then starts way lower for individuals who don't have any qualifying children. That's often news to individuals who are filing taxes for the first time, is that you do not need children to have the earned income tax credit. If you are between the ages of 25 and 65, and you don't have children and your income's low enough, you do get it for yourself. That is one of those things that can force you technically to have to file a return regardless of your overall income level. Maximum credit value amounts have gone up, so you're looking at $3,461 for 1 child, 2 children at $5,716, and 3 or more children at $6,431. These numbers, when you look them up online, are an example of those figures that I was talking about earlier that you might have to look up again because the IRS had to release a new revenue procedure to update existing numbers that came into effect before the passage of HR 1. So if you look up stuff about EIC online, it's very likely that it's wrong. So double check the amounts. It's not a very big difference, but it is there. And then the income phase out ranges are still increasing to inflation. So as you can see right there, the maximum phase out range, I mean, it starts to drop your credit at 18,660 for regardless of your children, and then 40, 45, 49, and so on. And then married filing joint has an increase in the range. It's one of the many ways that the tax code actually benefits individuals who remain married and in traditional family units. So these figures will be replicated themselves later in the year in publication 596, along with all the charts that shows the exact amount of credit that you get based upon your HEI. And with that being said, I'm going to go ahead and throw down here to talk about that kiddie tax, because I do know at least 5 or 6 offices where this is going to be significant, and possibly significant for anybody who files returns from Alaska. And what they did with the kiddie tax is they simplified it to apply trust and estate, ordinary and capital gains rates for net unearned income. So the net unearned income for your children is going to be normally subject to the old rules. For the kiddie tax, they get the estate and trust rates, which are really high and have much lower income brackets. So if you're below that threshold, the lower one, you're probably going to be okay. But it's when you start getting into, $3,000-$4,000 or more that you start hitting these break points where you're going to start having a much higher tax rate. And it's going to be reported on the child's own return. Believe it or not, there is no age minimum to file a tax return. If you had a baby that technically was a partner in an S corp and earning unearned income, they had to file a return, possibly even be considered not a dependent. It's kind of strange, but it's the truth. And under old law, the child could file their own return, or they could file on their parents' return subject to certain conditions. But instead, in this point now, kiddie tax is just reported entirely on the child's own return. It doesn't use the parents' tax rate, uses the estate and trust tax rates, goes on their own return filed separately. As a positive, however, is that the tax itself is now no longer affected by the parents or the siblings. So if you had 6 kids and they all had a piece of maybe grandma's inheritance or something like that, a little bit of interest and dividends from the estate, it's not going to stack up to where suddenly you're going to be paying at the adult parent's top tax rate for like 4 kids that happen to have a small amount of tax on each one of them. So there's tons of different ways this can go. Can definitely cause a tax burden for people who are under the new rates, but at the same time, it is divorced from other kids in the family and the parents themselves and subject to their own rates. This does, however, result in a far higher tax rate on the average for the net investment income of children. So I do want to keep that in mind. Might want to consider looking at those tax rates, looking at last year's returns, and seeing if you're going to be dealing with it. The few test runs I've done with a couple of returns I've looked at, in some cases have resulted in, thousands of dollars of difference. So, okay, education benefits. The tuition and fees deduction for the Internal Revenue Code Section 222 was renewed for 2018, set to expire again after 2018. 529 plans that were allowed to distribute up to $10,000 in expenses for tuition incurred with enrollment or attendance at any public, private, or religious elementary school applied on a per student, not per account basis. This one's big right here. Student loan debt discharges from death or total and permanent disability are excluded from gross income during the suspension period, or the suspension period for most other things, from 2018 through 2025. That does mean if you have a student loan debt discharge because you passed away or because you get disabled, that it's going to be considered tax-free. Generally speaking, your student loan debt was never considered dischargeable. You couldn't 982 it and get rid of it as a reduction of taxable attributes. You'd have to include it in your income, and student loans are really high. It's over $1 trillion market, and some say are waiting to burst. So this does give a little bit of benefit out there. Other than that, there are still discharges that are allowed for individuals who work for a certain amount of time in certain types of professions. That are capable of doing this. And the law did also expand to not just do government loans, but also private student loans as well under these rules. So death, permanent disability, certain professions and so on, government, private, excludable from gross income. Unfortunately, if you have student loan debt discharges that are not subject to those, then you're probably still going to be sticking them on your return and paying taxes on them. The residency requirement, the state-based residency requirement for your ABLE accounts has been eliminated. They're not a very popular thing that I see too often. So fortunately, unfortunately, I'm not able to too much information to be given to you guys about that one, but I do know that there was some rather restrictive rules on residency that helped or that prevented people from being able to claim ABLE accounts for disabled students to their maximum benefit that they've eliminated a little bit. Income thresholds for reducing American Opportunity Credit, they've remained the same. So IRC Section 25A, your normal $80,000 to $90,000 single qualifying widower had a household threshold for the AOC, or joint credit of 160 up to 180. That stays the same. Lifetime learning credit, full credit under 56,000, phases out from 56 to 66,000 for your single head of household qualifying widower. Married filing jointly, full credit under 112,000, and a phase out from 112 up to but not over 130,000. None of those are significantly different. The numbers are still the same. The credits themselves are still calculated the same. They're still going to have the same benefits that taxpayers are looking forward to. So nothing too terribly different from that. There is some stuff with due diligence that's going to be coming up where AOC still matters, and I'll get to that in a minute. Qualified education expenses that are paid through interest from Series EE and I bonds can be excluded from your income if your MAGI or your modified adjusted gross income is below certain limits. The phase-out range that you can claim through the Form 8815 under IRC Section 135, that's a little bit different. 117,250 up to 147,250 for joint filers, and from 78,150 up to 93,150 for all other filers. I do have a section here talking about Pell Grants. I just want to kind of point out to you guys that you can recharacterize Pell Grants as being used for personal living expenses in order to free up the amount of tax-free educational assistance. I've actually done that a couple times this year, where you can go through and take some of this tax-free income and stick it on the return as income and pay taxes on it, quote unquote, in theory, but in reality, what you're doing is opening up the credit for more expenses, because the American Opportunity Credit as a pound for pound credit is one of the best ones that's out there. $4,000 becomes $2,500, of which $1,000 is refundable. I mean, that's pretty good. You know, it's 100% of the first 2,000 and then 25% of the last two added on top of that. So, you know, it's a pretty good one. I know a lot of people use American Opportunity Credit. So if you ever have that situation where a Pell Grant makes it so that way the tax-free portion keeps them from claiming it, you shift it back over. It's not really a change, but it's something I do want to remind people that is still in play and is not taken advantage of near enough in my mind. Healthcare provisions, individual shared responsibility payment, what we call the penalty, repealed for tax 19 on or 2019 onwards. For 2018, it's still in play. So right now, you don't have health care, you're going to get a penalty for it, or you're going to have to work about getting an exception to that individual shared responsibility payment. But that's one of the keystone arguments that was advanced by the administration, was the repeal of the individual mandate. Despite the fact that it was declared to be considered constitutional, the legislature always has the ability to get rid of it, and they did. They got rid of it. So the individual mandate is going to be gone from 2019 onwards, but it is still in play right now. That being said, the penalty itself has not gone up. So it can be either a flat amount of $695 per adult, or $347.50 per child under 18, up to a maximum of 3 times the flat rate, or $20.85, or 2.5% of the household income over the filing threshold, up to the cost of the national average bronze plan sold through the marketplace, whichever is greater. So, I mean, that basically works as however many individuals, up to 3 times per adult, you know, on a monthly basis. So, I mean, the calculation can be a little bit complex, but that $695 is a month-by-month thing. So if you had an adult that didn't have coverage for the last 6 months of the year, you know, $347.50 would be what he'd be paying, stuck onto his tax bill. There are multiple exceptions that you can qualify for through the 8965 in order to get out of that. I would say probably 90% of the people, not even joking, just about 90% of the people who don't have coverage are able to get out of paying a penalty on it just because the insurance premiums are really high and they break that threshold for affordability. That required contribution threshold itself, speaking of, drops. So 8.05%, it was 8.16%. In prior tax years, it's dropped down to 8.05% for the affordability threshold, which gives a little bit more wiggle room for individuals to be able to get exceptions to the ISRP. The affordability threshold for the premium tax credit eligibility and the employer mandate, however, drops down to 9.56%. From its original number. So they're safe harbor thresholds basically that they have in order for healthcare costs to be considered affordable. Essentially, that you can't pay more than 9.56% of your income from an employer in order for the plan to be considered affordable. They get a little bit of an extra percentage point wiggle room just because an employer doesn't know your personal financial history for each one of his employees. So if someone is paying for health care through the marketplace, they get a little bit of a wiggle room in there in order to give themselves the ability to give people health care but not be penalized because they can't undercut the government's rates. Medical expense deductions, like I said before, 10% threshold from 2019 through 2025. So right now, 2018, 7.5%. It's going to revert to everybody for 10% under IRC Section 213. I do want to point out, though, that 7.5% threshold, by the way, doesn't just exist now for 2018. It also exists retroactively back to 2016. So if anybody who might have not been at the appropriate age level to get themselves at 7.5%, they were, under age 65 and itemized medical expenses, it might be a good time to do an amendment on those returns and get them in there and try to get that extra 2.5% of the AGI that they weren't capable of claiming, get a little bit of a tax credit, and see if they get a refund from it. The eligible long-term care premiums that are included in the term medical care themselves under IRC 213D10 have increased as well for each age category. So for 40 or less, it's $420. 50 to 59 is, 40 to 49 is $780. 1560 for age 50 to 59. 4,160 for 60 to 69, and 70-year-olds or older, it is increased to 5,200. Since 2013, the IRS has allowed you to roll over year-end flexible spending account balances of up to $500 into the next plan year. Doing so, however, makes them ineligible for being in an HSA in the same year that they roll over that balance. Flexible spending account contribution limits, however, have increased under IRC Section 125I to $2,650, and there also is an increase in the HDHP out-of-pocket maximums under IRC 220C2A, and that's the self-only plan at $6,650, and the family plan at $13,300. I mean, most of these inflationary adjustments are sub hundreds at best, $50, $100, $200. This is really no exception here. It's not a very high increase, but it is still beneficial for those individuals who happen to be participating in an HDHP or contributing to a flexible spending account or something similar. The limitation on the repayment for the excess advanced premium tax credit, or APTC, is the same in terms of its percentage of the federal poverty level. That's IRC 36BF2B. Your unmarried filers, single, married filing separate, basically if they are less than 200% of the federal poverty guidelines as described by the Department of Health and Human Services, they pay no more than $300 back. And for those of you in the audience wondering what I'm talking about, if you get too much advanced premium tax credit, you went through the marketplace, you got an Obamacare plan, you received money paid to your insurance company in the form of a premium tax credit. You find out at the end of the year that you didn't qualify, or you didn't give them the right income, or something changed and you got too much money for that plan, should have been paying out of pocket, you pay that back. However, there's a limitation. Like I said right here, 200% FPL is $300, 200 to 299, $750. 1,275 maximum for 3 to 399% of FPL, and all other filers, $600 for 200%, $1,500 for 2 to under 3, and then 300% or more, $2,550. Anybody who is at 400% or greater, or who files separately, generally speaking, usually is going to be paying all of it back. I mean, I guess married filing separate can technically be capped with FPL, but 400% or greater is going to be paying all of it back regardless. So that federal poverty level itself, there is a link clickable in the resources section at the end of the guide that you can actually go and look those up. Those federal poverty level percentages are broken into 3 groups, and it's going to be for individuals on the mainland, individuals in Alaska, and individuals in Hawaii. They contain the figures describing what the federal poverty level is for a certain family size, and then it gives you calculations if you have a giant family. It's usually 8 or more individuals you have to start adding manually in order to get them figures. The software itself happens to calculate that automatically. Every commercially available software platform that I've seen does so automatically with the 8962. And I do see a couple of questions popping in over the side about ACA issues for 2018. They definitely did repeal the individual shared responsibility payment for 2019 onwards, but it is in effect for 2018. And if this is news to you, I would make sure to let your clients know, especially if there are any exceptions that they can qualify for in advance. The Department of Health and Human Services, healthcare.gov, do have packets, application packets that can be used by your clients to apply for and obtain copies of the exemption certificate to claim an exemption from the penalty in advance, as long as they do it on time. I know some common things for hardship, for instance, if there's any, if you get a shutoff notice, a utility shutoff notice during a month, where an individual is not going to be capable of, or possibly going to be at risk for losing one of their home utilities, that right there can be used as sufficient evidence, for instance, to prove that you've faced a hardship. I'm not really going to cover too much that, but you can definitely go to the healthcare.gov website, take a look. They do have a whole bunch of different application packets in advance. If you get that ECN early, that means you can do the exemption, drop the certificate number on it, and then the IRS doesn't really question it because it's already been vetted for the year. Okay, miscellaneous expense or miscellaneous information. We're going to start getting down towards the end here. Standard mileage rates. Standard mileage rates are not going to be anywhere near as interesting for people, considering that employee-related unreimbursed business expenses are no longer deductible. But for those individuals who do happen to run a sole proprietorship or actually do have the ability to take these, the standard mileage rates have actually dropped. So business has dropped down to 54.5 cents a mile. However, the amount of that is attributable to depreciation and used to figure the adjusted basis for people who are flipping between the actual expense method and the SMR has increased to 25 cents. Medical and moving expense mileage, where it matters, 18 cents. Medical moving expenses in particular, we'll cover that in a minute. Those are different, but where it does matter, it's 18 cents. Charitable contributions are 14 cents a mile, or charitable miles are 14 cents a mile, and those are locked by statute and not inflationary. That's just been the same forever. So 54.5 cents, 18 cents medical moving, 14 for charitable, and a quarter per mile for the depreciation figure for factoring basis in between periods of switching on the SMR and the actual expense method. Miscellaneous changes from HR1. And like I said, most of these are going to be covering individual stuff, but some of these are businesses and also individuals who happen to have businesses. And one of those, bonus depreciation. Bonus depreciation is the other name for special depreciation allowance. And or the acceleration of alternative minimum tax credits in lieu of bonus depreciation. It was limited originally to 50%, but it was expanded to 100% for first year depreciation under IRC section 168K. That actually retroactively applies to September 28th, 2017 and goes through tax year 2025. So if you've noticed in the software, there was an update. If you were filing with us last year, for instance, you noticed there was an update after the Bipartisan Budget Act was passed, for instance, where they pushed down the ability to deduct PMI and so on. That right there did include a section that had 50 or 100% as long as the date was September 28th or later. That also does allow for qualified used property. That's a big one, used property. Originally, bonus depreciation was only for new property, but now it can be used on used property so long as it's new to the taxpayer. So there's no longer, you don't go buy something brand new in order to get bonus depreciation. You could buy something used so long as it's new to that taxpayer or new to that business and be able to deduct it. As well, it also has a bone to throw to the entertainment industry, and that certain film, television, and live theatrical productions do happen to have bonus depreciation provisions as well. In regards to Hollywood and their accounting, it's like a mystical science, and they are very, you know how it is. They got a multi-billion-dollar blockbuster that somehow still shows a loss. Well, they get bonus depreciation on their productions now too. Section 179, expensing maximums raise pretty substantially. $1 million, section 179, okay? So that's IRC section 179B1, D1A2, and F1. Okay, so maximum raises to $1 million of value in property that can be placed into service during the year, and the investment limits where they start to limit this type of stuff increases up to $2.5 million. Work opportunity tax credit. Any of you employers out there possibly using this, that ends in 2019. So IRC section 51 credit from that. That was 2018, still good. 2019. Not good. Employer wage credit for active reservists, once again, ends in 2019. It's IRC section 45P. Exclusion from income of the discharge of qualified principal residence indebtedness. Retroactively extended to 2017 by the Bipartisan Budget Act of 2018 and present with an asterisk for 2018. Taxpayers with QPRI in 2018 can exclude it from income so long as a written binding agreement existed before the end of the 2017 tax year. That's the provision that's allowed under IRC 108A1E. And what you're talking about is you have a home, you foreclose on it, you got a $200,000 mortgage and they forgive it. You know, that under old law goes on top of your tax bill. So you pay taxes on $200,000 because now you look at basically having cancellation of debt income. So they've traditionally kept the exclusion of that from your income for a while now, and they did in 2018 extend it back. So 2017 it was still good. That same bill was the one that also allowed PMI deductions and some other things. However, not present for 2018 unless they extend it again by the end of the year. I have heard some mulling about on that. If you can fit that into any, if you can look at the news and see anything else other than investigations and so on, I have seen a little bit of discussion about that. And what we're looking at, however, is not to plan for it. So if you have anybody that's foreclosing this year, unless they had that written agreement in place before December 31st, just expect that if they have discharged principal residence indebtedness, okay, that it's going to be on top of their returns as income, okay, and that they're going to have to pay taxes on it, although in many cases the amount discharged will be significant enough that they could probably give it a similar treatment by doing a 982 reduction of taxable attributes because of insolvency or, you know, to the extent of their indebtedness, and as long as they keep in mind that they're going to need to justify that if the IRS decides to question it, then they should be fine. But just using the regular QPRI section of the 982 won't exist unless they extend it again. That being said, you have any taxpayers right now that you know are going through a foreclosure or they're going to have a discharged indebtedness, make sure they keep records of all their expenses. They need to know how much their bills were. They need to know what their medical bills were. They need to know all of these things. They all go on the insolvency worksheet. It will help them to actually have the receipts or to have access to them, because if you put it on 982, there's always the possibility the IRS sends you a letter back saying, okay, this is cool, but prove it. And you know, if it's not substantiated, then the IRS can technically wave a hand and say it doesn't exist. So, I mean, obviously it's bad enough to where they're going to lose their home. You know, it would substantially benefit them to keep good records just in case this ever comes up, because it's a difference possibly between a couple $100,000 stacked onto a tax return and income versus being able to get rid of it all. So there's that. Deduction for mortgage interest premiums treated as mortgage interest, extended for 2017 only, set to expire for this year. As of right now, PMI is not on the docket. I looked so hard to see, because there was a lot of conflicting evidence and really weird vagaries in the way certain publications were released on the IRS website, but I can't find anything that shows that MIP or PMI, whatever you want to call it, is going to be around for 2018. And with the limitation on itemized deductions being one of the principal focuses of this bill, I am not surprised in the slightest. All right. Continuing, miscellaneous changes. There were changes to gift tax, gift tax and estate tax and so on. The annual per person exclusion amount raises to 15,000 from 14,000, and the amount that taxpayers can gift to a non-citizen spouse for a non-taxable gift value is increased to 152,000. It's IRC section 2503 and 2523 I2. In addition, the unified credit for against the estate tax increases, just basically doubles up to 11,180,000, but keeps the 40% top tax rate under IRC section 2010. So usually when you do your gift tax exclusions, they get it tax free, but you count against that unified credit. So you just have a running tab, if you will, a running tab that starts off at $11 million that every gift that you make counts against that figure, and then eventually when the individual passes away, whatever's left over is going to be the non-taxable portion of their estate. Generally speaking, that is a very simplified description of what I'm talking about, but that was one of those things that significantly impacts extremely high income clients, a very small percentage of only a couple thousand households in the country, and that's what they did. They doubled the estate tax amount, or the estate tax unified credit. Foreign earned income exclusion rises. So $104,100 per person for tax year 2018 under IRC 911B2DI. So that one right there, a little bit higher. Got people that are working overseas. They get a pretty good chunk of their income is not going to be subject to taxation so long as they meet the bona fide or substantial presence test for the 2555 or 2555 EZ. I know that a lot of people have utilized this in the past for government contractors. So it's just something to keep in mind. As that figure was 102,000 something last year, it's gone up. All right. Adoption credits. Adoption credits are popular. Back when they were refundable, they were very popular and e-fileable, I should say. But the amounts still increase to inflation, generally speaking. So the adoption credit maximum increases to 13,810, and the phase out starts at an AGI of 207,140 and goes away completely by an AGI of 247,140 or more. And those same limitations also apply to exclusions of adoption assistance payments or adoption programs, typically that are done through work. And those are all contained in IRC section 23 and 137 in some form or another. So if your boss is paying for adoption assistance payments or programs, up to 13,810 could possibly be excluded. And same thing for getting the credit in the first place. That also forms the maximum for dependents who are special needs dependents who need to have that adoption credit on their return. So once again, there's no change to whether or not it's e-fileable or not. It's not. It's going to be paper filed. Usually it has a high substantiation requirement, but most people going through an adoption have a lot of paperwork, so it's really not that hard to put on there because it is such a big number. The IRS likes to take a little bit of extra precaution. Expatriate taxes. Anybody that's possibly expatriating out of the United States got to take a look at their average annual net income tax and figure that calculation out to determine whether or not they owe any money before they're given clearance to leave. That figure for the 5 taxable year period equals 165,000 or more, makes them a covered individual, and they get a reduction of their includable income in the amount of $713,000, IRC 877A, and I have yet to actually see that happen to more than one person on a return, so not very common. Casualty and theft deductions, that's a big one. If you live in an area that has floods or fire, or you have something stolen, generally speaking, in a prior tax law 2017 and earlier, your casualty and theft deductions, you'd be able to do a 4684, and after a 10% of AGI consideration and then a reduction of $100 per theft or casualty instance, you would be able to claim a casualty or theft deduction against your income and be able to save a little bit of tax money by reducing and itemizing it. There actually were provisions as well for the hurricane hit areas to where they would essentially increase their standard deduction by casualty and theft deduction amount without having to itemize for the rest of it. So it's been fairly beneficial, especially for those coastal states over the last few years. However, from 2018 through 2025, except for areas that are explicitly in a presidential disaster area as defined under the Stafford Act, can't use it. It's gone. Just gone, no more. Now, I can say that you get 1 year of wiggle room, and that's because existing tax law about casualty and theft deductions, unless this is clarified by future IRS rulings or legislature, allow you to use casualty and theft losses to apply to the year prior. So a 2018 loss could potentially be deducted in a tax year 2017 return through the form of an amendment, so long as you have enough substantiation. Should be able to go ahead and do that on the return. Now, of course, that's an area open to interpretation. I have seen a few people say that they don't suspect that the nature of the law allows that to happen, but since that prior year application of the casualty and theft loss was not touched, I have seen a lot of people suggest that it's possible, and I'm erring on that side, generally speaking, and of course, further developments might possibly change it. Moving expense adjustment, that's the 3903. It's an adjustment to income on the front of the 1040, lowers the overall AGI. Gone. 2018 through tax year 2025, just gone, except for in-kind moving expenses for certain active duty members of the military or armed forces moving pursuant to official orders or change of duty, something similar. So if the United States government has you in the armed forces and they say you got to move across the country at your own expense, then you can use it. Everybody else completely out of luck as well. What I don't know is whether or not that 3903 being pulled back means that the grandfathering of the 39-week test for application of 3903 deductions following the move to an area for new income. I mean, there's some higher level stuff that we may probably need to get more bulletins on, but if you used it in the past, I would generally say for those individuals, just make sure that they keep records of their employment during that time. So if the IRS does decide they want to go back and try and take it off of a previously filed return, that your clients don't, mistakenly think that they have the ability to just move and violate that presence test, if you will. Entertainment and meal expense, this one's big. So not only are employer or unreimbursed employee business expenses, because they're a 2% AGI miscellaneous itemized deduction, just gone for the suspension period, entertainment expenses are significantly impacted. So right now, meal and entertainment expenses usually are 50% limit, okay? If you have an entertainment expense in general, it's gone. 2018 through 25, gone. It does keep 50% food and beverage expense associated with operating a trade or business. So meal expenses are still okay when you have the ability to use business expenses at all, which is going to be typically on a business return or sole proprietorship and so on. But the entertainment expenses are pretty much just gone at this point. It does, however, expand the meal portion to include employer-provided meals through an eating facility that meets de minimis requirements and is for the convenience of the employer. As well, it also gets rid of transportation, some of the transportation stuff. I think that's actually on the next slide. You do have the ability to get 100% of the deduction for expenses paid and incurred under a reimbursement arrangement or something similar. So those ones are still those ones are still the same. They're not really impacted by this. But just generally keep in mind, entertainment expenses gone, meal expenses are still okay, but it's harder to use them overall because your 2106 expenses are completely axed during the suspension period. Transportation expenses, this is what I was trying to get at just a minute ago, disallows qualified transportation fringe expenses under IRC 132F as a deduction, except when absolutely necessary for the safety of an employee or any expenses incurred for commuting between the employee's principal residence and the place of employment. So a lot of bosses would be able to provide commuting benefits and qualified transportation fringe benefits, and it not only was not taxable to the recipient, but they were capable of taking a deduction. That's gone. So if the employer has, putting money out of pocket to help get people to his office, doesn't exist anymore. And that also does mean that if he does continue to pay it, that the employees are going to have to include it on their W-2 and pay taxes on it. And then a lot of this stuff comes down to as well, why the numbers are different is because there's been a change in how the inflation is calculated. Okay, so the inflation calculation goes from using the CPIU to chained CPI for 2018 onward, which, before I give you the long description, just means that things are going to go up slower. So that's generally not beneficial for most people, because that means that the credit amounts are going to go up less as well. It might also mean that the income brackets don't go up as much, but if your own personal expenses and income rise faster than the inflation rate for the taxes, then you might be paying more taxes overall. So the CPIU is what they were using before. That's the Consumer Price Index for all urban customers, and that is developed and published by the Department of Labor. And essentially, they include a bunch of individual income tax amounts for these inflation-induced tax parameters like tax bracket, standard deduction, aged and blind deduction, savers credit, IRA contribution limits. I mean, they're all tied to this figure. But under the new law, the dollar amounts that were previously done, they're going to be instead indexed using Chained Consumer Price Index for all urban consumers, and it's permanent. This is not something that's going to go away unless they go back and change it again. You just generally expect that things are going to inflate less. And this is the reason why a lot of the stuff online that you look up is going to be different than what it is in this presentation, or for instance, our AFSP guide, because what you are looking at is that they had to release new documentation this year in order to clarify stuff that they thought they were good to do last year. Okay, so a repeal or suspension, repeal/suspension recap. This is very brief, non-exhaustive. I mean, I've got 6.5 inches of books to my left just on this bill right now. Okay, like total between all the other stuff that I have, and even then, that's not enough to finalize it. So there's a lot of stuff. I'm trying to give you the crib notes version, and I have a much prettier version of that one over there on the side. Discharge of principal residence indebtedness. Gone unless you had an agreement that existed in 2017. Mortgage insurance premium deductions, gone, unless you're talking about putting on 2017 return. Tuition and fees adjustment to income. When I mentioned that earlier, I believe I misspoke a little bit in saying that it was present for 2018. I'm not trying to say it was present for 2018. What I meant to say was that the Bipartisan Budget Act extended it retroactively for a 2017 return, but that it was set to expire in 2018 unless it's added back. And I doubt very highly that that will be the case. We do have a midterm election coming up and SCOTUS cases about a bunch of other stuff, so it's bound to be a somewhat crazy year. Moving expense deduction for non-military, gone. 2% of AGI floor for miscellaneous deductions, gone. That includes employee business expenses and investment expenses. Those two big ones right there. Those are the ones that I see people use when it comes to that. That does also include some other miscellaneous expenses, like you can no longer deduct tax prep fees or include the cost of tax preparation software in lieu of tax prep fees on that Schedule A. So that whole section is just completely wiped out. Entertainment expenses, gone. Casualty losses outside presidential disaster areas, gone. The base for mortgage interest deductions after 12/15/2017 lessened down to $750,000. So people who might not have had to prorate before might have to prorate now. And I will tell you right now that old rates and old law is grandfathered in. If your mortgage existed prior to 12/15/2017, then you can still use up to $1 million base in terms of the amount that you can deduct for interest on that Schedule A. HELOC or home equity line of credit or equity line deductions are also gone. Like I said before, that was originally up to $100,000. The interest attributed to that, those are gone, but don't pay attention to the label, pay attention to what it does. Okay, I might possibly have a little blurb type of newsletter thing out sometime within a couple of weeks to clarify that, but don't just look at the name of something, look at what it does. Acquire or improve a home is more important than whether the loan's called equity, credit line, or mortgage. Okay, individual mandate for the minimum essential coverage, gone for 2019 onwards, still applicable for this year. I generally feel that the administration's directive to the IRS probably will preclude them from taking any serious action from going after people who do not have healthcare coverage. I mean, the IRS tax law and the software still has the indicators that need to be filled out that state whether they have coverage or not before otherwise they can get rejected. So you can't just leave it blank and ghost mode that into the system and try to get it past the IRS. I mean, it still will get rejected for it unless they change that. But I just doubt very highly that after all this is said and done, that the IRS is going to seriously pursue individual shared responsibility payment. I haven't seen them pursue it even when it was in full force and with a different administration. And that's just personal conjecture. right there on my own. So just don't take that as gospel, but just keep in mind, if you do have anybody that does not have health care right now, have them look into exceptions, have them look into getting an exemption certificate number, have them try to get figures for how much it costs so that way they can have an accurate calculation when they're trying to come up with an 8965 affordability excuse. And now that the affordability threshold dropped from 8.16 to 8.05, that does give you a little bit more wiggle room in order to say something's unaffordable. Personal exemptions as well, like I said before, gone, hopefully balanced out by the presence of child tax credit and family tax credit. But, you know, something to keep in mind is that they're not there, and the numbers themselves will be relevant for gross income tests, for qualifying relative, and so on. And I'd imagine that those will likewise be in Pub 17 in the future, and so on. IRA Roth recharacterizations. You got to stick with what it was when you made it instead of being able to flip-flop around up to the due date of a return. And then LCG rates tied to brackets, that's also gone. So long-term capital gain rates are decoupled and are indexed separately under the CPIU. Or sorry, from CPIU to the new chain CPI. All right. Now, that's most of the tax law stuff that I'm going to be covering. Technically, I still got you on the docket until I'm done when we've reached our minimum amount, if you will. But what I'm going to go ahead and do is talk to you about something that's important to you guys, and that's preparer penalties. You still have the same penalties: 66.95 A, B, C, D, E, F, and G penalties. $50 per return or per claim to refund for not giving a copy of the tax return to a taxpayer, for not signing the return as the preparer with your PTIN, for not being able to furnish an identifying number with that PTIN number on the return, not keeping a copy of the return or a list of the returns and when you prepared them, failing to file correct informational returns. Okay, and those all have a maximum annual penalty of $26,000. The final two on here, 6695F, negotiating a check, you don't ever get their money like directly. Like, they don't give you their tax check. It doesn't go into your bank account and you give them the leftover. There are special arrangements, aka bank products, that most of you guys already know about if you're a federal direct partner, that you can use in order to pull your funds out of the refund. But if the IRS finds out that you have a direct hand in controlling any of their money, then that right there is $520 per check or per refund check or amount, and no limit. They can stack that up as much as they want to. So, you know, no 8888 refund splitting. And the IRS still has the 3 times per account deposit limit anyway, so they've been able to stop most of this. Due diligence for child tax credit, earned income tax credit and additional child tax credit, American Opportunity Credit, and head of household, section 6695G, $520 per item. I have an asterisk next to head of household because you had, because of the 8867, a due diligence requirement for earned income, child tax credit, and the American Opportunity Credit, but now you also have it for the head of household filing status. So you've got 4 opportunities on a return to fail due diligence. And 4 opportunities failing a return at due diligence means that if you didn't do it right, or you just don't keep notes on a client, that's a minimum $2,080 per person with no maximum limit, that you could be stuck with a civil penalty, possibly sanctioned, censured, or, you know, put in jail if the IRS really wanted to get nasty about it. They have jailed almost 4,000 preparers in the last year over this. So I just want to keep in mind that they are really going after it, because we lose a lot of money through fraud. We actually, I mentioned this in some of the other webinars, especially over the dependents, that the amount of money we lose off the earned income credit alone is larger than the military budgets of every other country on the planet except for Russia and China, if I'm not mistaken. So it's a fairly large amount. They take it very seriously. Some other penalties, section 6701, $1,000 individual or $10,000 corporate for helping somebody understate their tax liability. Neglect or intentional disregard of rules under 6694A is the greater of $1,000 or 50% of income derived or to be derived, or willful understatement of liability greater of $5,000 or 75% of the income derived or expected to be derived. So they're not playing around with these guys. I'm serious. These figures are annually updated, and they're also required as a mandatory facet of the annual filing season program. So, and I'll definitely cover and touch base on when I do the Circular 231 as well. What to expect this season? We're in the home stretch here. So more political gridlock, election year. no one really knows exactly how that's going to turn out. I mean, everybody's got a finger, in that pie in the news cycle. Who knows who's going to win? Who knows who's going to take control of the House? It could be more of the same. It could be completely different. It could be opposite ends standing across from each other screaming. Who knows? I have no idea. What I do know is that a lot of stuff needs clarification in order to make it usable by the IRS. And generally, to my knowledge, the IRS doesn't like to decide on things without legislation because they tend to lose in court when they try to extend their power on that one. So possibility for debt ceiling and budget battles, et cetera, another fiscal cliff again, whatever. Tax reform, highly likely, but I don't mean of the same caliber. Unless we completely flip the legislature and they just undo everything, which would be an absolute mess, it's just very likely that we're going to have additional legislation here and there to fix holes, to fix loopholes and patch things up and clarify points that need to be clarified in order to make this better. And then as well, this is not a change, but it's something that I want to keep people reminded of, is that if you have a return and they have the earned income credit, the American Opportunity Credit, or the refundable additional child tax credit, they will never get their refunds processed prior to February the 15th. They added that a couple years back. A lot of taxpayers are not getting the message. And I get calls from preparers wondering where the refund is. I see it's got EIC and it's January 29th. And I say, well, you got to wait at least 2 weeks before the IRS even considers processing it. Historically, last year, it was the 3rd and 4th weeks of February where the refunds started to come in for those clients. Okay, so that still happens to be the same. I just wanted to make sure that you guys are aware of that. And if you didn't know it before, you do now. And then finally, last one, projected start date, January 15th. This is one of those few times where every single start date actually happens to fall in the middle of a week. Doesn't fall on a holiday and doesn't fall on a weekend. So January 15th, 2019, due date, April 15th, 2019. And of course, your partnerships and S Corps, I want to point that out. They have due dates that are unified now, have been for a couple years, but the IRS is still facing this problem. Your partnerships and your S Corps are due in March. They used to be decoupled from each other, one in March, one in April. They're both in March, so that way them schedules K1 can get applied to an individual return. Friday, March 15th, 2019. There are other due dates for other facets of the code, but I'm not really going to spend a lot of time adding on about it. And I've kept you guys on here long enough. I can say that 15th January start date right there, I'm not 100% certain that that's going to be real. Generally speaking, the perfection window for the beta testing, if you will, of a few early returns that can start being sent in the beginning of January will happen. So you'll be sending returns in and they'll be sitting in a queue, but the actual start date almost always falls in the 20s. It's been like that for the last 8 years that I have been aware of, from when I started doing this particular role and job. So I would expect even further, considering the depth of changes, that this is probably going to be the same. Lots of software updates, software coming late. I just expect it to be a madhouse, because this is the most substantial change to the tax law, like I said, since the 80s. So 3 decades, it's been a long time coming one way or the other, and it's probably going to have some impact. Resources, IRS main site, Pub 17, Rev Procedure 2018-18-10 as well, if you wanted to find that one. The Joint Committee on Taxation's list of expiring federal tax provisions, federal poverty guidelines, and the Social Security contribution and benefit base. All clickable links. If you have any other suggestions for resources, feel free to let me know. There are a lot of players in the CE game, a lot of people out there with PDFs and presentations. I've seen a couple of CE providers with 8-hour courses over this particular, bill, because like I said, it's very large. So, I mean, there's plenty of things to pick from, plenty of resources. Just double check the Revenue Procedure 2018-18-10 in particular. Those will have better numbers rather than relying on the Forbes websites and the Wall Street Journal websites and everything else, unless you notice that the date is more recent. And you, by the way, in most of your search filters, you can also go to the more tools on the side and filter to a closer date, so you can try and get rid of some of those older figures that are using the old pre-Rev Proc adjustments. So